Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week it was my turn to catch up again with Andrew McHattie, the editor of the Investment Trusts newsletter, who, as always, is right up to date with all the things that are happening in the investment trust sector. And my word, there's been a lot of other things going on this week and last week, which we're going to talk about. Never a dull moment in this sector. So, Andrew, let's kick off first of all by talking about the Japanese stock market for a change. This has been prompted by the fact that there's been a snap election in Japan and we have a new prime minister. The first ever woman Japanese prime minister, who has a very radical plan. And it seems, judging by the initial reaction, that the markets like it. But there are plenty of things to talk about in that context. So first of all, tell us your immediate reaction to the result of the election and what's been happening in the Japanese sector, which, as I say, has been pretty strong.
It has, yes. Thank you, Jonathan. Well, it's a very interesting market at the moment, I think, both politically and in terms of what's happening financially. So the Prime Minister, Sanae Takaichi, came back to the electorate for a second time to ask for a stronger mandate. And this was a bit of a gamble on her part, I think. But it worked very nicely, and that mandate was duly given. She really won very convincingly. And that sets her up nicely now to advance a strong platform, I think, of pro-business policies and some fiscal expansion. And the market was quite naturally very enthused by this. So the Nikkei is up 8% over the month. And this has been very good news, as we would expect, for the mainstream Japanese investment trusts. So JP Morgan Japanese, Schroeder Japan, and CC Japan Income and Growth are all up between 9 and 11% over the last couple of weeks. So that's a very fine short-term outcome. Of course, we'll have to see what happens from here, because sometimes, of course, when reality sets in, as it always does, it proves to be a little disappointing. So we'll have to see if that's the case this time around.
I think what we can say for sure is that the whole backcloth in Japan has definitively changed. We know that the stock market peaked in 1989 at a ridiculous PE ratio, and then there followed the sort of 30 years or so of deflation, and every effort to get prices to go up again in Japan failed to materialize. And then suddenly here we are, as of the last 2 or 3 years, we've got to a point where Japan now has positive inflation, and its bonds are now yielding gone up to around 3 or even 4%, which is basically unheard of for the last generation of investors. So this is a significant development. And of course, there are some caveats to go with it, as I think you've said. If you believe in what's called the yen carry trade, this is the fact that a lot of professional investors borrowing money in yen very cheaply and then using it to invest in more higher yielding assets. If you think that's been a significant factor in global equity markets, then this trend is going to reverse that. So there are things to worry about. But in terms of the investment trusts, I think we've waited quite a long time for some of them to perform well. There's a distinction to be made between the kind of core Japanese investment trusts and the more specialist ones focused on activism, is there not?
That's right. And actually, over the last couple of years, it has been those investment trusts more focused on corporate reform that have been leading the way. And so it will be interesting now to see if there is some sector rotation that goes on, whether those mainstream trusts do catch up. And I'm not sure in the near term just how much more we can expect of the Nikkei and the mainstream stocks, because they're up by 47% over the last 12 months, which is a phenomenal run. As you were saying, I think much of this was long overdue, but sometimes, of course, markets get a bit over-enthused, don't they? And my feeling is that it would not pay to get too excited at this point and switch all of your money into Japan.
Yes, I think it's fair to say that some of the names in the investment trust sector, they have not kept pace with the benchmark, I don't think, over a year at least, the last 12 months. So they have performed very well. They've not all kept up with the benchmark. There's always an issue in Japan about which benchmark you look at, of course. There's significant differences between the benchmarks, between the topics and the Nikkei and things like that. So there's significant differences there. But I would pick out that the trusts that are focused on activism have actually lagged one or two of the more core Japanese investment trusts over the last 12 months. having comfortably outperformed them over the previous period. So it will be interesting to see. This has some relevance, of course. We saw a merger in Japan amongst Fidelity Japan merging, somewhat surprisingly, I think, with the AVI Japan Opportunity Trust. So that's been quite a recent development. Maybe the shareholders in Fidelity Japan feel that maybe they did the wrong thing there. We don't know. Have to wait and see. So if you look down that list there of the names that do survive, would you still be favouring, as you're implying, the activist trusts rather than the core mainstream ones, or would you have both?
Well, I think now there's a decent argument actually for having both, or even switching purely to a mainstream one. And there, I think you have some good options. So, JP Morgan Japanese is an excellent large liquid trust with a fairly reliable track record over the longer term. And that's a possibility. And one that I have featured a few times over the last few years is Schroeder Japan, which I think is actually slightly better and tends to be available on a slightly better rating as well. So I think there are some good options. CC Japan as well actually has really come up on the rails more recently. So I think depending on whether you're looking for any income and really how much faith you have in the continuation of that corporate reform story, I think there's quite a few good choices here. And you're quite right. You don't just have to choose one. You could very happily go for a mix.
And what about the small cap trusts? Because obviously there are ways to invest in trusts that are investing only in small and mid cap companies. You had something to say about Baillie Gifford trusts in the past. What do you think about their two trusts now? Both of which have been disappointing, I think it's been said, until more recently they have perked up again. It's partly a matter of style, but also there may be broader questions to ask there. What do you make of their trusts?
Well, I do think that Baillie Gifford Japan has picked up after quite a significant time actually in the doldrums and lagging the other trusts in that segment by quite some way. But if we're looking at the smaller companies trust, Baillie Gifford Shin Nippon, which we've definitely spoken about before in not such glowing terms, that is still struggling. And I do feel you've obviously spoken about the challenges to the management there. I do feel that that is possible. That trust is on the clock somewhat, and it really does need to try and pick up its performance. Now, it may do so because there could be, I think, some cyclicality here and some switching of favourite sectors, but I'm not that convinced. And I think at the moment, amongst the smaller companies trusts, it's quite hard to look past those more focused trusts that are looking at the corporate activities. So Nippon Active Value Fund in particular. And I also think it depends a little bit on what your time frame is. So for many investors, they're looking quite long term. And if you're looking at maybe 5 to 10 years, then there's plenty of time for much more of that corporate reform story to play out. And I think maybe you'd be looking at Nippon Active Value in that regard.
I guess the Japanese stock market has benefited to some extent from this general trend of many professional investors reducing their exposure to the US in favor of other markets. And we've seen that in emerging markets as well, and lesser extent in Europe. So do you think that's been a factor as well, and that could well continue? Or are you one of those who think that maybe this kind of pushback against having too much in the US has gone too far, and there could be a bit of a reversal in that trend?
You dismiss America at your peril, I think. Many times over the years, it's been tempting to do so, and America has powered ahead throughout. But actually, I jumped aboard this train quite early last year, probably a little bit too soon, when I really felt that US equities were at some frightening valuations, and that especially with the dollar weakening, and that apparently being encouraged by the US administration because it helps to support their manufacturing aims, I felt actually that there was a very good case to be made for switching away from US assets. And that, I think, has been the theme of the beginning of 2026 here, because if you look at the performance of global markets since the turn of the year, the US is basically flat, maybe up 1%, depending on which index you look at. Whereas actually most other markets, excepting India, have actually done very well. So Europe's done okay, that's up about 5%. The UK's been fine. Japan, as we've been talking about, has been strong. And then you have the outstanding case of emerging markets, and those are up on average by 11% since the start of the calendar year, which is a phenomenal run. And I do think that has to be down to people switching assets out of the US and into other markets on lower valuations.
And of course, we have also had the news since we last spoke about the new chairman of the Federal Reserve. The candidate who succeeded there seems to be one who is, at least on past track record, probably not going to rock the boat as much as one of the other leading contenders might have done by giving in, if you like, to Donald Trump's very pressing and repeated demands for lower interest rates. This is Kevin Walsh, who's been appointed as the next Federal Reserve chairman. You might argue that that might weaken a little bit this sort of anti-US trade. But do you have any views on the new Fed chairman and how it's going to play out? Do you think that's an important factor, either positive or negative?
Well, it might be an important factor, but I'm not sure I have anything useful to say about it because I have limited expertise there. And I think it's tremendously difficult to read these kind of things if you're not actually in the US, if you're not an active participant in the markets there. I think it's quite difficult to tell what the relationships are. But there's definitely a risk, I believe, in the US of inflation re-emerging because you're going to see actually the quite important tax cuts coming through as part of Trump's big, beautiful bill, which means that actually tax rebates will be arriving for many Americans actually in the next couple of months. So they'll have more money to spend. That's happening at a time when asset inflation has been going ahead quite strongly, with the exception of Bitcoin of late. So I think it's quite risky actually having any suggestion of sharp decreases in US interest rates at this time. So there's plenty to watch. It's definitely an important factor. I'm just not sure I'm the right person to ask about it.
Well, that's a very fair comment. I mean, I'm happy to say that I'm totally with you. And as far as I'm concerned, last year was, for once, a relatively simple year to get right. And it was also a year when you had to do what basically the consensus was saying, which is somewhat unusual, which is move away, reduce your dollar exposure. But we can still look at the price of gold, which has obviously had a very dramatic start to the year, but it's still up around 14% if you own one of the ETFs, physical gold ETFs. 50%. That's certainly speaking, I think, to your concerns about higher inflation in the US, among other things, and geopolitical issues, of course, as well. So, yeah, I'm with you on the general trend for what it's worth. But as you say, very difficult to get those macro things right. It's more a question of tilting your portfolio rather than basing it all on those concerns, certainly if you're an investment trust investor. We talked about the US and we talked about what's happening over there. And of course, there's been a huge amount happening in the world of AI, artificial intelligence. Well, there's a lot of debate about whether AI is going to be the real thing. There's a lot of debate about whether OpenAI or Anthropic are going to pull off IPOs or not. And there's been a lot of debate about what the impact of AI is going to have on different sectors. And we've seen quite sharp, sudden sell-offs in different sectors, in insurance, in wealth management, and in software stocks. Quite short-lived in one sense, but that had a very significant impact on a very well-known and successful and popular private equity trust, HgCapital Trust. And we might just talk about that. What is your interpretation of what's happened and how the shares of HgCapital have responded?
I do think we need to talk about this, Jonathan, most definitely. AI has now become the subject at the top of pretty much every agenda. So in almost every investment trust meeting I have now, we talk about AI. It's taken over from President Trump and before that Brexit. So the cycle has turned. And it's having a very powerful impact. And HgCapital found itself last week, actually, at the center of the storm. And this was really quite a surprise because HgCapital Trust, I think we can say without contradiction, it's a very highly regarded trust. It's one of the best long-term winners in the whole of the investment trust sector. If you look at long-term performance tables over 10 years or more, you will find HgCapital Trust in the top 5 or so investment trusts. It's not normally very volatile. And then suddenly last week, the shares started to plunge. They really went down very rapidly. And over the course of just a few days, they went down by 25%, which was really quite extraordinary. If you look at a long-term chart of HgCapital, this is a completely unprecedented moment. And at the time, we didn't really know what was driving it. So I had a look around and I couldn't find anything specific that was wrong with HgCapital itself. So I eventually discovered that this was because there was a big sell-off in the US software sector driven by fears about AI. And this was especially triggered by the launch of a new productivity tool by Anthropic, who added some functionality to their Claude co-work platform specifically for legal work. And that, I think, triggered additional fears that many of the professional software packages that were available in the US were going to be undermined and threatened by this. So the listed US software sector went down very sharply, about 25 to 30% in many cases. And it was that had the knock-on effect for HgCapital, because, of course, it has to mark its unlisted portfolio against some kind of valuation benchmark, and that includes listed software companies. So effectively, the market was saying, well, we can see that you're going to mark your NAV down very significantly, which is why the shares are coming off now. And incidentally, we think maybe some of your companies are going to be suffering here. Now, that was actually, as it happened, a short-lived collapse in the share price, and they've recovered actually very, very well, almost back to where they were before. And I think HG actually needs a bit of credit here for how it responded, because I think it had a very clear message in response, which is really reiterating what it's always said, that it is focused absolutely on mission-critical software in areas such as accounting, legal work, healthcare. Really, these are realms in which you cannot afford a mistake of any kind. And we know that AI can be great for 95% of the time and then awful for 5%. And that's no good when you're getting your accounts right and dealing with people's healthcare information. So that was helpful, I think. And then HG also came out with an end-of-year NAV that was actually up slightly on the quarter, although I think it might be marked down next time. And also it announced a new share buyback program, I think designed specifically to soothe the market. And that all seemed to work. So I think in the near term, HgCapital has dealt with this issue quite well, but there are longer term questions that remain. And the market, I think, will have to figure out whether HgCapital is going to be a winner or a loser from AI.
Yes, I think you've summarized the situation very well there. And of course, this is what everybody is trying to work out. What impact will AI have? If you look beyond the obvious high profile, the Magnificent Seven and the hyperscalers, these big companies that are actually building the infrastructure for AI, if you look beyond them, everybody's trying to work out which of the companies who are actually going to be using AI that are going to be most effective, using the tools that AI can create. And you're absolutely right. And we've seen 2 or 3 of these sudden market squalls where just the announcement of some new AI tool sends some investors into a spin, basically. But the lesson so far seems to be, well, you don't want to be spooked by that. You certainly want to take your time before you panic into selling into those kind of moves. And it is interesting for HgCapital, I think, because, as you say, they are very heavily focused on software sectors. And therefore, it will be a function of whether or not people come to the view that these AI tools can actually replace, can code, can create the software, and then use them in applications that don't require human intervention or human knowledge. And I think that one is still to be worked out. I think it's very fascinating. So there may be some long-term issues here, as you've said. I think it's fair to say that HgCapital's performance over 5 years has not been as good as it's been over its longer term. Over 5 years, total return around 8%, which is okay, but it's not into the double digits that it's had over its longer life. So I guess there is some question here. And the other factor being, what about the discount? Where, HgCapital has often traded close to par, whereas a lot of other private equity trusts have clearly not. So what do you make of the discount? I mean, is that still an opportunity, do you think?
Well, I think there's quite a lot to say about this. And you're right that HgCapital is one of those trusts because of its high reputation. It has quite often maintained a premium rating or perhaps a narrow discount, whereas much of the private equity sector has been on a far, far wider discount. Now, that discount has come out to 17%. And of course, you have to be careful about thinking about the exact NAV that's based on, because HgCapital's NAV is, of course, a trailing NAV. So the current one we have is for the 31st of December. And I think it's reasonable to anticipate that actually the next net asset value will be lower because of this decline in the US software companies. Now, if that is the case, then the actual discount is smaller, of course. So you've got to be quite careful with the numbers here. And my feeling is that HgCapital is probably fairly priced at the present time. I'd be wary of chasing that discount because I'm not sure it's as real as it might at first appear. And there are many other questions here. I wonder whether, in fact, HG might end up being a significant winner out of this, because it does really focus very much on AI itself and making sure that its portfolio companies are at the forefront of this and hopefully carving out competitive gains as a result. So HG actually formed a separate little subsidiary called HG Catalyst, which has 80 people working for it who do nothing but AI. That's what they're utterly focused on, making sure that they're combining the AI functionality with the other capabilities of their software companies. So they may well actually have a bigger competitive advantage than they've had in the past. There's a lot to sift through. And certainly HgCapital is not the only investment trust to have been hit. One of the other casualties over the last month has been Finsbury Growth and Income, one of Nick Train's trusts. Shares there are down 12% over the month because it holds quite a lot in Relics, in Sage, and in Experian, other companies that could be under threat here. So I don't think we can ignore this question. And whilst it's a difficult, tricky thing to get into, and even Ben Rogoff of Polar Capital Technology has said quite openly for a long time, hasn't he, that he doesn't know quite what the impact of AI is going to be. He just knows it is going to be very impactful. We've got a lot of work to do, I think. We've got some sorting out to do and some decisions to make.
Yes, it's good you mentioned Nick Train's trust, Finsbury Growth and Income. And of course, I did notice that of the two, Polar Capital Technology and Allianz Technology Trust, Allianz, Mike Seidenberg, who's the manager now, he is their kind of expert in software. And they've always had a slightly higher exposure to software, I think, than Polar Capital Technology. And their shares have not done as well as Polar Capital Technology, but they're both up slightly this year. So they haven't been kind of hit by, if you like, the reverberations from any of this. The other thing I think one can say with confidence is that, as you've implied, this is not going to go away. There are going to be other things. All these companies are going to produce other tools which may or may not impact different sectors, and you've got to follow it very carefully. And it certainly suggests quite a lot of volatility coming up. While we're on the subject of big names in the investment trust world with strong track records, we might quickly give a mention to 3i Infrastructure, which I know I have in the past referred to as the class act in the infrastructure sector. Well, not every path is smooth. There's been some news from 3i Infrastructure. Perhaps you could take us through that, Andrew.
You're not alone in that view of 3i Infrastructure, Jonathan. I've recommended it many times. This is always regarded as a high-quality trust, I think. It's really, in many respects, the go-to trust for infrastructure. It's been top of that sector quite consistently over a long period, producing reliable returns for shareholders. But it has achieved those higher returns partly because it invests in operating businesses rather than just assets that throw off cash flows. And one has gone spectacularly wrong, I'm afraid. The trust had a £212 million investment in a German fibre-to-home company called DNS Net. And that is being written down to zero. So it's complete write-off. And that's quite a shock, actually. And this wasn't really anything that 3i Infrastructure did or missed. It's that the circumstances changed. And because of conditions in the German telecoms market, funders have been reluctant now to provide capital to that particular sector. So DNSNet is a casualty, and 3i Infrastructure had to write off 5.6% of its asset value as a result. So that's a bad outcome. And it does, I think, pose some interesting questions here. Question marks over whether you should stick with the trust, first of all. And my opinion on that is that you should, because there are always going to be bumps in the road for operating businesses, albeit this is a big bump. And I think potentially the trust could get over this quite quickly because there is a possible sale of its largest holding, TCR, on the books. And if that happens, I think that will overshadow this quite quickly and overcome it. But there are a couple of lessons to be learned from this. I mean, possibly one is that high reputations don't protect you from risk. And so just because a trust is very highly regarded and everybody speaks well of it, doesn't mean that there's no risk. And you always have to bear that in mind as an investor. I think the other thing is that, of course, we've got so used to hearing the risk warning that past performance doesn't guarantee future success, that that's become completely trite, hasn't it? And I think we probably ignore it. So the regulatory requirement to state that over and over has probably become counterproductive, and nobody takes that message seriously anymore. But you really must. Just because something has done well in the past doesn't mean it will in the future. So you really have to look beyond past performance tables and consider what the risks are and look ahead. That's what this game is all about, I think.
To which I might add simply, it's quite difficult when you're looking at a trust like this, which is very substantial, 3 billion in market cap, I think, something like that. And you can't sort of drill down into, or the market can't even drill down into every holding that the trust has. And there may be surprises in there that you won't see coming. And this trust, I mean, for 5 years, it traded at a very significant premium between the start of 2018 and the end of 2022. But now it's on 15% discount, which is kind of level that hasn't been seen very often. So if you're right, this could be an opportunity. If it does recover or get over this particular hiccup, this could be an example, rather like HgCapital might be. You've suddenly got a chance to buy a trust which does have a very high reputation, but has a temporary or possibly not temporary problem at a significant discount. So it's the kind of thing you should be looking at least, I would say. It looks oversold on the charts. At least have a look at it, because this might be a buying opportunity. Might.
I would agree with that view, Jonathan, yes.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's go back to our friends at Saba Capital. Quite a lot to talk about here. Their latest requisitioning of a meeting and attempt to oust a board was with Herald, following on from the one they had with Edinburgh Worldwide. Tell us what happened and where you think we go from here.
This is another big topic, this one, and another messy one, actually, because very little has been resolved so far. So let's start with Herald, where Saba effectively blocked the tender offer there, which Herald had constructed really as a method of allowing Saba to make a reasonable exit at close to NAV. And Saba has decided not to accept that. And so effectively that blocked that offer. And there was then a backstop tender offer, which was intended to allow other Herald shareholders to exit before Saba took control. Now, that has also been stalled. So that has not been implemented immediately because the board of Herald say they are in discussions with Saba about a way forward. Now, I would love it if they can find a way forward, which is reasonable for everybody concerned. I'm not sure that's going to happen, though. And the real fear for me here is that actually this is signalling the end of Herald as an independent investment trust, because effectively, if Saba can't exit and there's no agreement here, then there will be the backstop tender offer. Everyone can get out. And I think that effectively signals the end of Herald, which would be a great shame because it has an excellent long-term record. And there's a similar limbo, I think, for impacts environmental markets, where a similar kind of vote structure has been proposed. So that one, we don't know yet what's going to happen. That's still all to play for. And it's very much the same with Edinburgh Worldwide, where Saba's requisition to oust the board and install its own directors, and effectively, I think that's a prelude to Saba taking over the management of the trust. That was voted down by shareholders for the second time in January. But Saba has now said it's intending to requisition another vote at the AGM, which is due before the end of April. So it's becoming Groundhog Day here. And this is costing money every time. Now, we don't know exactly how much it's costing, but I've tried to look up some estimates, and it's probably somewhere between £100,000 and £300,000 each time. So Saba is burning through the money here of other shareholders who I think will be very frustrated by the whole thing. And my sense is that Saba is just hoping to wear shareholders down. It's hoping they won't bother to vote next time, and eventually, therefore, they will grasp control of this investment trust. I'm hoping actually it's going to have the opposite effect, that they will have galvanized everybody who's going to make sure that even if they didn't vote last time, they're definitely going to vote this time to make sure that Saba can't keep requisitioning these meetings and can't have its way with this trust.
Yeah, it is a complicated situation and difficult negotiations to be had. I mean, if Saba continues to say we're just not going to play ball, then it says this rather desperate outcome of Herald going out of business might materialize, and the Edinburgh Worldwide one is just as complicated. Do you think that Saba's latest statement about the situation at Edinburgh Worldwide, which came out on Thursday, changes any of this calculation?
Well, it might actually, Jonathan. This is quite interesting because Saba has, of course, been criticised for not telling us really anything about what it planned to do with the trust if it did gain control. But now we do have at least one little piece of information, which is quite important. And that is that Saba has said that should its directors be elected to the board, then it will offer an unlimited tender offer to shareholders, enabling them to sell out at a 1% discount to NAV. And that's a major point, actually. That really could change things. So this could be enough for some shareholders to say, fine, we'll end this sorry saga and we'll exit this way. And it doesn't need that much of a swing in the shareholder vote for that to be the outcome. Now, if that were to be the case, I'm not sure where we'd be left, because actually, perhaps if a lot of shareholders leave, then Saba is not left with a sufficient amount of capital to continue. So it's a gamble on Saba's part, I think, but it certainly is a new interesting twist to this.
Can we read anything into the behavior of the discounts of these various trusts? So Edinburgh Worldwide is trading at a small premium, but Herald is trading at a 8.5% discount, according to numbers I can see, which is, in Herald's case, is right in line, just a little bit narrower than their average over the last year or so. And Edinburgh Worldwide is obviously much improved. It's at a premium rather than at a discount. So what do you think we can read into that, if anything? Does it suggest that there may be a different outcome of these two trusts? They might end up in different places?
I don't think we can read that into these figures because, again, we have to be careful how we're interpreting, I think, these asset values. Because in the case of Edinburgh Worldwide, with its significant holding in SpaceX, that is due to have another revaluation, and it's likely to result in a considerably higher value. And I did see some calculations suggesting that if that is incorporated here, then that premium on Edinburgh Worldwide then reverts to a discount again. So again, we have to be a bit careful with these figures. I suppose that in the case of Herald, on a 9% discount, that's really not telling me anything. It's just saying the jury is out, because it's not saying we know we're going to get our money back at asset value, but equally it's not saying anything else. So if you have some wisdom on that, Jonathan, please share it. But I don't think I do.
No, I don't think I do. As you say, I think the points you made are very valid. And obviously, it's difficult to get the information about this because if the chairman of the boards or the boards themselves are in negotiation with Saba, we don't have an inside track on that. There may well be people in the market who have a better idea of what's happening than others. That's often the case. I won't say more than that. But so far, I don't think we can read anything into it ourselves at this point, sitting outside the process. But it's one to follow, obviously, because the negotiations presumably cannot drag on indefinitely. There has to be an outcome in due course. And as you say, the concern for those shareholders in the trust that have voted to reject Saba, how many times will they keep coming back to do so? That's an important question. In terms of Saba, there's one other thing that's been going on. Obviously, we know they continue to add shareholdings in one or two additional investment trusts. They do have a very wide range of holdings now, over 40 or so. But ironically, perhaps you might feel it's also been having some issues around its own funds in the US, which is something we might quickly mention.
Yes, and it is worth mentioning just because it will give certain people a little bit of satisfaction that Gabelli fund managers have proposed a new trustee for two of Saba's closed-end funds listed in New York that are on discounts of about 11 to 13%. They feel actually that they need to get involved to start to narrow those discounts, which certainly feels like a dose of its own medicine for Saba. And what is interesting here is that Saba has proposed merging these two trusts together to form a larger trust, hoping that that would narrow the discounts, which was, of course, part of the argument for a merger between Edinburgh Worldwide and Baillie Gifford USA, which hasn't happened because Saba blocked it. So there's some quite interesting contradictions at play here, and we'll be following what happens with the closed-end funds in New York with interest, I think.
And I think the other bit of news about Saba is it has obtained, I think, preliminary approval for a new fund over here. If it succeeds in getting control of any of these investment trusts, the speculation is that they will use that new vehicle to hold their holdings in investment trusts. And then, depending what they do with them after that, will be interesting to see, and maybe other discount opportunities. So I'm clear that the Saba story is going to continue. We have to accept that, whether you're in favour of what they've done or not in favour of what they've done. There's no getting away from the fact that it's going to be in the headlines for the investment trust sector for a long time to come. Let's move on again and talk about something completely different. Let's talk about DGI 9 infrastructure, which has an unfortunate distinction of being one of the worst performing investment trusts that have launched in the UK market for a long time, currently trading at a few pence per share. Some people have been pushing those shares as perhaps a recovery option, maybe thinking that the thing has been overdone. The trust is basically winding down or in liquidation, but some people thinking there may be scraps to be had from that. What do you think? What do you make of the latest news here? It has been a very large trust, now much, much smaller, of course, but it's one in which a lot of people have invested. What do you take away from this week's news?
Up to this point, Digital 9 infrastructure has been a complete disaster, hasn't it? And it's not getting any better, actually. So the news this week was that ahead of its end of 2025 valuation point, the trust has warned the market to expect a nil valuation for Arqiva, which is one of its really key holdings. And that's not a surprise because of other corporate actions we've seen relating to that company. But it does mean that the stated NAV, which was previously still quite high at 32.7 pence, is going to drop down to something like 8.5 pence. So a massive reduction. So again, that just teaches us to be very careful when we're looking at stated NAVs for alternative asset trusts. The enormous apparent discount actually wasn't real in the first place. So the shares are down at 5.3 pence here, and about half of that value is now accounted for by cash because they have sold some of their assets, and you will get a little bit of that cash back, but you're not going to get all of it because actually there are some quite big management fees here that are going to eat into that amount. So that's not good news. I suppose if you're looking forward, you can say that the stake in Arqiva still has some option value because there are some binary outcomes that are going to be coming in 2027 for regulatory and contract matters that could mean that there's a turnaround there and the value of that company goes up significantly and Digital 9's stake has some value. I'm not thinking that's going to happen, and certainly the market price is not indicating that's going to happen. But if you are a shareholder here and you've lost money, maybe now isn't the time to sell your little remainder, your rump, if you like. You could hang on to it. But so far, this has been a speculation with a very bad outcome.
It certainly has. I mean, 5p from 100p is not a good performance, we have to say. It has been one of the shockers of the wave of trusts that have come to the market and false hopes in the past, but it's now really down in the end of life situation. It's in the hospice, if you like, and they may be able to carry out one limb, I suppose, from it, but it's only, I think, I would say, a plaything for professionals who try to play the 5p, will it go to 7p game? But for those who have hung on all this time, yeah, you might as well. There's nothing to be lost, really, I don't think, at this stage. So let's move on to a slightly different situation. Let's talk about Oryx International next. Again, change in contrast. Tell us about this one and why you've picked it out to talk about this week.
This is a curiosity, I think, and I love finding these curiosities in the investment trust market, which is a rich and gloriously colourful sector full of all sorts of good things. Now, this is not a very well-known trust, even though it has actually quite a well-known manager. It's about a £200 million trust, this one, managed by Christopher Mills of HgCapital, who many of you will know quite well, actually, for his activities in the sector. Oryx is a trust that he's managed for a long time, and it's a very concentrated portfolio of UK smaller companies. Now, it's not that well known. It has a wide dealing spread. If you go and visit the website, it's quite difficult to find very much information. The managers don't really like to talk about it too much. They stopped producing monthly fact sheets in 2022, so you've got to do some homework here. But the reason I've highlighted it now is because it has jumped higher, because there have been a couple of bids actually for its portfolio companies. There was one called Kitwave, which was at a 40% premium, and that added about 9 pence to net asset value. It wasn't a particularly big holding. But there's also a possible bid on the books for Pinewood Technologies Group. And if that does come to pass, that will add another 22.5 pence to the NAV. And this, I think, just stimulated me to take a fresh look at Oryx. And one reason it's interesting is that it is on a 26.2% discount. And maybe that exists for all of those reasons I've outlined. There are many reasons why you wouldn't invest in this. But of course, Oryx is from the same stable as Rockwood Strategic, which is trading on a premium rating. And I think maybe it's worth a look. Actually, the 10-year NAV return from Oryx International is second in the UK smaller companies sector, second to Rockwood Strategic. So it's quite an interesting one. Out of the way, and it won't suit everybody, but maybe worth a look.
So it's fair to say that Christopher Mills is a well-known figure in the investment trust world. HgCapital, his firm, he also manages North Atlantic Smaller Companies, which is another trust that has an interesting portfolio, and now has those two small cap trusts, Rockwood Strategic and Addition. So yeah, thank you for pointing that one out. There is a big discount, which may be of interest, but I mean, it has tended to trade at quite a big discount, I think it's fair to say. Would you agree with that?
Well, it has. There's all kinds of reasons you can argue for that. It's illiquid for a start. Christopher Mills has a big stake. It really isn't chasing any PR, and it's not communicating well with the market. And it is a concentrated portfolio. I think there's quite a lot of risk here. So I think there's all kinds of reasons actually why you might not choose to invest. And I think if you do look at it, you've got to look at it through the lens of a fairly long time frame, because I think the dealing spread's often quite horrible. And also, this doesn't tend to move very much. If you look at the share price chart, it's very lumpy and it has long periods where it doesn't move at all. So it's not something for traders, but it could still be, I think, quite a good long-term investment.
Okay, thank you for that. So let's move on then to another trust which may be of interest. It's more of a niche trust than a large well-known name, but that is Baker Steel Resources Trust. Why is that in the news? Well, one obvious reason is it's in the resources business, and commodities in general have been doing very well. Mining stocks, gold, and so on have all been performing very well. But tell us about Baker Steel Resources and what's special about them.
There are some commonalities here, I think, with Oryx and Baker Steel Resources Trust. They're both second-line trusts, relatively small. So Baker Steel has net assets of about £160 million. They're not that well known. They often, I think, fly under the radar, and they're both on a 26% discount. Now, Baker Steel Resources Trust has, of course, benefited hugely from being in the resources sector. We've all seen the big rise in the gold price, and that's been replicated across many other commodities, which I'll come on to. And Baker Steel shares are up 36% over the month, so they certainly joined in. And it's about time, because this has been a bit of a sector laggard actually over 5 years. But I think it's an interesting collection, again, of smaller companies. This is managed by Trevor Steele and Francis Johnston, who are definite specialists in the sector. They're commodity men through and through. And I think this is an interesting trust that maybe is now reaching a catching up period, because the last couple of months have been really excellent here. So the end of December NAV showed a monthly rise of nearly 18%, and the end of January NAV showed a further rise of 12%. So it's really firing on all cylinders now. And that's coming from some unexpected directions as well. So its third largest holding is a real British success story, actually, quite a new success story, and a company called Tungsten West. Now, you can have a look at this. It's a London Stock Exchange listed company. I would urge you to go and look at the share price chart, because it's quite remarkable. It's had an enormous surge in value. Now, it's really interesting because it's recommissioning a tin and tungsten mine in Devon, actually just near Plymouth. And that's really gained so much extra value because of these rising commodity prices. Because, of course, these mines are very highly geared operationally. The tungsten price has gone up about 4 times since the start of 2025. So it's gone up fourfold. And that means now there's a very impressive potential payback on this mine. So that's really helped Baker Steel Resources. And at the same time, there are a couple of other bits of really good news. One is that the trust's largest holding is in an Australian coking coal miner called Futura Resources. And that has actually had a slightly complex corporate situation where a company called IRH, International Resource Holdings, had an option to buy Baker Steel's stake and to take over Futura. But that option has now lapsed. And that means Futura is now free to progress on a much more stable basis and really to find the best way forward. So that's good news, I think, for Futura. And Baker Steel has also recognised this big discount, so 26% discount, and it's just started for the first time a share buyback program to hopefully narrow that as well. So this is still a high risk position. It's a trust that has a bit of a mottled track record. It's investing in a small collection of very specific mining companies, some listed, some unlisted. You've got to have a strong stomach for this one, but I think it's in a very interesting position just now. And this could be just the moment, I think, where it's going to do really well.
Well, that's very interesting. I mean, I've followed this trust for a number of years, and as you say, it's very volatile, long-term track record, very variable, which is what you expect from a company that invests in mining companies and other types of companies that are already highly geared. You've got the commodity prices zigzagging all over the place, and you've also got the gearing on top of that. But very interesting and very good to hear that the Cornish economy is being given a boost here by what's happening in the tungsten market, which is not one that I personally follow very closely, I have to say. So, yeah, go into that one if you do with your eyes open. So let's go back to the property sector, and let's talk about the forthcoming changes to the FTSE indices and how that impacts on at least one of the players in the property sector, which we haven't talked about for a while now.
Well, this was a small item of news that just caught my eye. What I read was that Tritax Big Box REIT is potentially going to enter the FTSE 100 index at the next review at the start of March. I think it's on the 4th of March. Now, if this does happen, this will make 7 investment trusts in the FTSE 100, which to my recollection has never happened before. So Tritax Big Box REIT would join 3i, Scottish Mortgage Trust, F&C Investment Trust, Polar Capital Technology, Alliance Witan, and Pershing Square Holdings. So the reason I think this is relevant is that this is a great recognition of the relevance and status of investment trusts as a very important component of Britain's financial system. And of course, that's not something the regulators have a great track record of noticing. This has been a big issue in relation to the cost disclosure question, of course. And I'm just hoping that actually, as investment trusts become more prominent and more important, hopefully with more media coverage, so their status is more widely recognised and we get a bit more support from the regulators and the government.
I think that's a very good point that you make, Andrew, and let's all hope that this is indeed what happens. I mean, it's true there are a lot of investment trusts that are in the main FTSE indices. I think there's about 170 in the FTSE closed-end fund index, but they're mostly towards the smaller end of the capitalization range, some in the mid-cap, quite a lot in the small-cap sector. So yes, you're absolutely right. This is more of a higher profile. Do you have any thoughts about Tritax Big Box itself? It's one of the commercial property trusts that has survived the kind of cull of the last few years. What are your thoughts about that?
Well, I have been wondering for some time whether the investment trust REIT sector would survive at all, actually, because so many trusts have disappeared. And we've seen another one, actually, which we haven't talked about. Life Science REIT has received an offer from British Land, so I think that one's going to disappear as well. No great surprise there. But Tritax Big Box REIT is most definitely a survivor. It's clearly a company of scale, but it's also been in the right position because it's focused very much on the logistics industry, which of course has been such a massive beneficiary of the explosion of the internet, with online shopping, with so many more goods being moved around the country and needing to be stored. So I don't see that changing anytime soon. I think the trust is probably well positioned for future prosperity, and it pays a nice dividend. So I think there's quite a lot to be said for that. And I think it's, increasingly unusual because so many of the investment trust REITs have disappeared, or they've decided to convert into becoming operational companies. We've lost quite a few in the sector for that reason as well. So we need to celebrate this one, I think.
Okay, on that note, let's bring this particular episode of the podcast to an end. Thank you, Andrew, for your thoughts, as always. And as I said at the beginning, this has really been a very interesting start to the year, been a good one. I mean, the markets have been very positive on the whole, so people are making money out of their holdings in investment trusts. But there are still a lot of issues to resolve. There's Saba. We need to see those cost disclosure rules fully implemented, I think, though many trusts are already taking advantage of the new regime. And of course, we're going to see a lot of volatility around individual sectors. A lot of questions to ask. We'll be asking them. So thank you very much, Andrew, and we'll look forward to our next conversation, which will be next month.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.